Okay. Well, welcome. It looks like we've got a good crowd here. Welcome to Tax Consideration for Startups. In this session, we're going to explore the essential tax information that startups need to know, including entity selection, tax compliance, and potential deductions. We're going to discuss common pitfalls and how to avoid them. And we hope that you all will leave with a better understanding of how to navigate the tax landscape as you launch and grow a business. My name is Josh Doing. I am the Startup Success Manager at the UMD's Ventures. We work specifically with startups coming out of university IP, and so work primarily with graduate students and faculty. But we do this workshop series in collaboration with the Dingman Center that works with students, and it's provided as a service that's accessible to anybody who's interested in startups. And so we're happy that you're here. If you do have questions about anything covered in this workshop, or about other services that we provide at Ventures or through the various startup centers here on campus, please feel free to reach out to me after our conversation. This session is being recorded. We post all of our workshop sessions on YouTube as part of our Startup Fundamentals workshop series. We have our Q&A, which will be open today throughout the presentation. And so if you have questions, feel free to put them in the Q&A. I'll be monitoring that and finding good times to ask the questions. But yeah, please feel free to make this into what you need it to be and get the questions answered that you need. Our speaker today is Professor Sam Handwerger. He's a CPA and a full-time lecturer and a University of Maryland alumnus. He holds a Master's of Science in Taxation degree from the University of Baltimore, was a senior tax researcher with EY in New York City, and later led the tax planning and preparation departments of the CPA firm Handwerger, Cardenia, Funkhauser, and Lerman. In 1996, he was awarded the Governor's Volunteer of the Year Award in the state of Maryland for financial and management advisement to nonprofit organizations. Before joining the Smith School on a full-time basis, Professor Handwerger held adjunct positions at the Johns Hopkins University School of Business and the University of Baltimore School of Law. I don't want to take any more time from our presentation, so I'm going to turn it over to you. Please, again, ask me any questions, and if you as participants have questions, just throw that into the Q&A. Okay, I'll pass it to you, Sam.
Thank you, Josh. Nice introduction, and welcome everybody. This is going to be a big overview of taxation for small business startups. In the event that you are already starting up, you'll still find good information here, but we're going to concentrate on business plans that are in the works and just about ready to take off, and you've now sat down with your tax accountant to explore what you need to know, and that's where we're going to go. So we're going to go to screen sharing. Okay, startup taxes and tax planning, away we go. What will be the first order of business is to discuss the various types of business entities you may embark upon, and we're going to just do a brief overview of their taxation issues in the event that you choose a particular type of entity. Sole proprietorships is not exactly a business entity, but it is one way to start your business, meaning you don't create an entity, it is just you. And that's the emphasis on you. And it's not the recommended way from a legal liability standpoint, because since it is you, all your assets are at risk in the event that your business ventures are sued for some reason. So it's the preferred method when you're just starting something and you're just trying for a few weeks or a few months, and you're not thinking that you got much risk to get yourself in trouble. If you do a sole proprietorship from a tax standpoint, the tax is just as it is with the liability, it's on you. So there is no taxation entity. You pay the tax on any income the venture makes. The more preferred way to start up, I would say, is an LLC, limited liability company, as in the words, gives you limited liability, protects you from certain acts, discreditable acts, perhaps, as long as they're not fraud. That's definitely not protected in any business entity, but nevertheless, it's a good idea for errors and omissions, unless you are a professional like a dentist, doctor, lawyer, CPA, then your acts are not protected by the limited liability company regardless. Nevertheless, what this is it's a protected legal liability company is the LLC. Partnerships are not, but it's taxed as a partnership, and that's what we want to talk about. How are LLCs taxed? Very rarely would you really want to do a partnership. So LLC is not taxed, which means it is a pass-through entity. That's what we're going to call it. And with these, some of these terminologies are important to get at least an understanding, familiarity with today, so that when you are talking about it with a tax accountant for your particular business, you'll be familiar with it. So we call this a pass-through. What it does is the LLC passes through to your individual return its net income or loss, and that goes on to your individual return, and you'll either pay the tax, or if it's a loss in the first year or so, you'll have that loss to offset, potentially offset other income from your personal tax situation. So LLC is not a taxed entity, which is advantageous because you'll only pay one level of tax at the individual level. There's something called an S corporation. Probably many of you have heard of this, and it is indeed a corporation under state charter. LLCs are limited liability companies under state charter. S corporations are corporations under the state charter. And the S corporation is also of limited liability. So you got the same limits that the LLC has, and that's nice. So it's not a bad way to begin business. It is not taxed, and it is also, therefore, a pass-through entity. It passes through to the individual return the net income or loss from the business as computed by your records. So it passes through. And these pass-throughs pass through at the time that it happens. So if you're dealing in 2024, whatever the results of your business are in 2024 for LLC or S corporation, it passes directly through to your individual return. You pay the tax. If it's a loss, as I said, it may offset other income, which is, to some people who are working and making a salary, a little bit of a potential tax advantage in those first years when your startup may be on the negative side until it takes off. Okay. Finally, as what are known as C corporations, these are also incorporated under the state charter as corporations. They give you the full legal liability protection that LLCs and S corporations do. However, these are taxed entities, so they pay a tax at the entity level, and when they pay a salary to you, the owner, when they pay to the owner, there'll be an additional tax. So they are doubly taxed. There's two tax levels, one at the corporate level and one when profits are passed to the owner. You might ask, well, why would I choose to have a doubly taxed entity? And the answer would be because this gives you the ability to control when you'll pay the second tax. For example, the corporation makes a profit, put some green here, pays a tax on that profit, but it does not have to incur the second tax because it doesn't have to pay salary to the owner and it doesn't have to pay a dividend to the owner, depending on the facts and circumstances. So it has some degree of control as to when the second tax will be realized. And at the current level, at the current tax law, the tax rate at the federal tax on C corporations on the entity is 21%. So if you are full-time employee today, your tax rate may be actually higher than 21%. You might be 25, 28. It goes up to 37% for individuals at the highest rate. So you might be paying tax at a higher rate than the 21% if you do business as a pass-through entity. So you choosing to be a C corporation would not be the first choice, but there may be circumstances where it makes sense. So that's, but the bottom line is it is a doubly taxed entity, and it's probably not the best place to be for a startup. Why would you do a C corporation? For non-tax reasons. If you are on a track with your business plan to eventually go public, selling stock to either family members, close friends, other investors at a low level under SEC filing or a high level under public companies, C corporations are going to, that's where you're going to need to be. You could still start as an LLC and move up the ladder to C corporations. You can start as an S corporation and move up the ladder to C corporation, even if that becomes your business model later on. So I wouldn't worry. I personally wouldn't worry about how you start. I would start as the LLC or the S, leave it as a pass-through, one level of tax. What financial records do I need? Well, you need them. Okay. The answer is yes. Let's take a look at what some of them are. You'll need to keep your bank statements, your credit card statements. If you're not a bookkeeper, not an accountant, those are going to be what we call the source of original entry. That's where the accountants and the bookkeepers will get what business did you do, what income did you take in, what were your expenses. They'll get it from these kinds of statements. So you're going to want to keep those and do all your business through the bank statement and the credit card as well. You'll want invoices and receipts to prove what went on the bank statements and the credit card statements. So if you buy things, I highly encourage you to keep the receipts. If the IRS ever comes along and says we want the receipts, the statements from the credit card would not necessarily be enough. All of this will lead to a bookkeeper and accountant being able to create a profit and loss statement, which is probably self-explanatory. It will say what you made. It'll give you the proverbial bottom line. It will also show you the detail of how you got there. And you're going to want to have that for your tax return, whether you're a pass-through entity or a tax C corporation. Either way, you're going to want to have that. There's also another financial statement, but that's outside the scope of today's tax lecture. There's something called a balance sheet, which shows what assets and liabilities you have at any given time. And that's a nice statement to look at to help manage your business. Okay. If you have employees, you're going to want to have payroll records. If you are paying yourself a salary, which you can do when you are a S corporation, pay yourself a salary, you'll want to have the payroll records. And I would highly encourage you to use a payroll company to get that done. It is a complex world today. I would not try to do payroll on my own if I were you. And I'm an accountant. Okay. I think that sends the message home. So S corporations can pay a salary. Just while we're here, let's just dive it back to the pass-through entity of those LLCs. This gets a little complex, but I think just getting exposed to the concept would be helpful. And that is LLCs, the owners do not get salaries. They're not even allowed to. They can't get a salary. There's no salary, no W-2 wage. The owners are allowed to take profits out anytime. When you take profits out, it's just merely considered to be a distribution. Since you are paying tax on the income as it's earned, the distributions themselves are not taxable. They're just merely taking out what you're already paying tax on. So profits are taken out by way of distribution. It's not a tax event. As opposed to a salary in a corporate setting, the salary is a taxed event, but the different distribution of profits to the owner is just simply saying, hey, you're paying tax on whatever the profits are. These are the profits. We're giving it to you. We can give it to you tax-free. And you can give that distribution out in the year the profits are made. You can give it out the next year. You can give it out whenever you choose to distribute those profits from the LLC at any time. Similarly, with the S corporation, you don't have to pay yourself a salary at the time that the profits are made, but you would want to pay yourself a salary from the S corporation at some time. So, and let me explain that just a little more, because I think this is an important point. We've got a lot to cover, but this is an important point. S corporations do pay salaries, so yes, and the tax law basically says you have to pay a reasonable salary. That means that if you're working for the profits of the S corporation, which you most likely will be, you need to pay yourself some kind of salary. What I would suggest you do is that's when you want to have a meeting with your tax accountant to help determine what would a reasonable salary be and what does that mean, the reasonable salary. Let's take a little bit bigger dive into these issues of the profits of these pass-through entities and the salary issue. Let's take a quick bird's eye view between the two. Actually, I'm going to give away some current tax information that adds up to a legal tax loophole. I'm going to do this for no price. A legal tax loophole. LLCs are pass-through entities. Their profits pass to the owner. They pay the tax. The profits that pass to the LLC owners may or may not be subject to self-employment tax, SE tax. They are certainly subject to the income tax as they pass through to the return of the owner. So the answer there is yes, but the answer here is hard to determine. Maybe not subject to SE tax if it can be proven that the income passing through to the, proven is the wrong word, if it can be demonstrated by the facts and circumstances, which is what people like myself, my CPAs like myself, tax accountants do. We will demonstrate that the income, which let's say is 100, the self-employment tax amount, we may be able to demonstrate through facts and circumstances is only 50. So what's happening? If the SE tax is a tax of roughly 15.1%, it's an additional tax to the income tax. So that means you're paying more. Well, when you get a salary from an employer, you're basically paying half of that amount because this is the Social Security tax that all employees pay. The employers pay the other half. If you're in your business for yourself, which is what S corporations and LLCs are, then you have to pay both because you're the owner, you're also the worker bee. So the LLC gives you one advantage, and that is you can control the fate of your SE income a lot better than S corporations. And that's because the S corporations also pass the profits forward like the LLCs. They also do that, but which means the income tax will be paid on the profits as they're earned. That'll be the same. But the SE tax here in this situation, you have to pay a reasonable salary, which is to be determined. So here's the gimmick. Where I wrote that's 50, I might be able to make the argument that it's 50 as opposed to 100. Let me say this in another way. The profits of the LLC were 100. Who earned the profits? Who made the money? Well, if it's just you, then it's a pretty difficult argument to sustain that the SE tax should be on something lower than 100 if you made the money. If you were the only worker bee, how else were the profits made? Therefore, under the LLC in this picture, you will pay the full 15.1% self-employment tax. Whereas, and here comes the drum roll, whereas on the S corporation, you may be the only employee. You may be. But if your job description says that, hey, your reasonable salary is really 50, but your profits were 100, you will save 15.1% off of the 50,000 that is not considered to be subject to SE tax due to the fact that you're paying yourself a salary. Now, when you pay yourself a salary out of the S corporation, you're going to pay the Social Security tax that the employee pays and the employer because you're both. So what this amounts to is the fact that what you have as a potential tax loophole is the ability to pay less self-employment tax, less Social Security and Medicare taxes by choosing the S corporation route, to be determined based on your facts and circumstances. We move forward and we leave the SE tax for a later day. Just so you understand, when we say pass through to the individual, this is the general model of the tax formula for individuals. It's your gross income, which is income from all sources. Almost all income is taxable. You are allowed certain deductions for what they call for adjusted gross income that would get you. Now you're also allowed what you get you to adjusted AGI, which is adjusted gross income. Then you're allowed certain itemized or standard deductions. There are certain exemptions from taxable income, and it yields a formula that gets you to taxable income. So again, just to go through it, let's do the plus minus. It's a plus, less, gets the taxable income times the tax rate, gets your tax liability, and then there are certain credits available to individuals. So if you hear the word credit means it comes off dollar for dollar from your tax liability here. it's way below the formula, way below the lines in the formula, to the point where you get your amount of tax that's going to be due at the bottom. A deduction reduces your taxable income. That's good, but the savings of deductions is only at the same rate of your tax rate, whatever that tax rate is. The credits are a little bit better, or I should say a lot better, than deductions, because it's dollar for dollar off the tax liability. So if you hear the word today or another day that, oh, well, if you do this, you get a tax credit, let your eyes and mind open up, because that's something you want to pay attention to. All right, I think we've hit a lot of language. Now we can start getting into the nitty gritty of what being in business is all about. All right, having said that, let's move forward. Common business startup deductions. And these will be for even businesses that are operating as well. Before we get started, I want to just give you like a heads up. In order to know whether you got the right CPA, the right tax preparer, if you sit down and you say, here's my business, take a look at what my records are, you should expect that they should quiz you on other deductions that you might have that are not necessarily in your books and records. If they don't start asking you questions beyond what's in the books and records, then perhaps that's not the right person. All right. Deductions. If you're selling something, the cost of buying what you sell is a deduction. That sort of seems obvious because you only get profits above what it costs you to sell those items. We have something called depreciation and amortization. And one best way to describe the tax advantage of this is that, let's say you buy a property, a building for your business. So you buy the building, it costs you $1.0 million. Now, when you buy the building, it's not necessarily tax deductible at $1 million because it has a life greater than 1 year. It has a life of, well, it could have a life of 39 years. That's the tax code's life given to buildings, 39 years. So your depreciation will take the $1 million off of your income ratably over that 39-year period, which is nice because your building really doesn't depreciate, at least not in America. It is expected to either hold its value or appreciate, and yet you get to take off your taxes, albeit over a long period of time, the cost of buying the building. So it becomes a tax write-off, potentially. It's not a reason to buy a building, but it's a nice feature if your business plan requires buying a building. And it applies to other assets, equipment, computers, cars, trucks, applies to other assets. The advantage of other assets is sometimes, like computers or equipment, let's say lab equipment, is that you may be able to take the deduction of the depreciation 100% all in 1 year. Your tax accountant will know what you can do and can't do. It's called the Section 179 deduction. Why would you do it? If you have a good year, you're buying new equipment, taking the deduction 100% in the year you buy it, as opposed to depreciating it over time, is a tax advantage. Other deductions, home office. Sometimes you start off, you don't have a building. So the area of space that you use at home for your home office can be a tax deduction, not necessarily a huge one, but it is available. And a good tax accountant won't fail to bring that up as a possibility. Obviously, your supplies, your internet costs. Sometimes that internet is at home. That really belongs part of it to the business. So the internet is being used at home for the business, it would become a tax deduction. If you have somebody on the payroll outside of yourself, you're going to have payroll expenses because you're going to have the salary, obviously, and then you're going to have payroll taxes. On top of that, that's that half of that Social Security, payroll taxes. You're going to have a whole slew of state tax liabilities, unemployment insurance. This is a whole seminar in itself. The payroll taxes, unemployment insurance is required in Maryland, other states as well. Workers' compensation is required for payroll. So the list goes on, but you'll have all those are deductible. So the worst case scenario is it means employees cost you every dollar you pay an employee in the salary range costs you probably on average with your other benefits, healthcare benefits that you might have to put together and the payroll taxes, roughly 15 to, I would say 22% or 23% maybe additional. So it's never a dollar. When you say I'm going to pay you $1, it's never $1. It's $1 plus. I want to mention the use of independent contractors. Using an independent contractor is brought up here because if you pay somebody as an independent contractor, meaning they're not an employee, then all of this goes away. Oh, wow, you say, I should pay everybody as an independent contractor. Well, since it results in all this going away, the Internal Revenue Service, which enforces our tax law, has a lot to say on who is an independent contractor versus who's an employee. It's a big issue. Won't give you the whole 9 yards, but it's in 1977, when I was still a lad at the University of Maryland in the accounting school, the Congress passed a law that we are going to determine once and for all the definition between employee and independent contractor, so everybody will know. And we won't get into this controversy. Is this person an independent contractor? Is this person an employee? Congress said in 5 years, we're going to solve the issue, so everybody will know. Well, that was in 1977, and it's 2024, and we still don't have anything. What you have to then understand is be careful of calling somebody an independent contractor in order to reduce that extra cost on salaries, because the IRS is watching. They are losing that 15 to 20, well, they're losing the payroll taxes, and the states are losing it as well. So they're going to be very cautious as to whether or not they believe that who you calling an independent contractor is indeed an independent contractor. And just as a aside, the independent contractor is reported not on a W-2, salaries are reported on W-2 forms, like when you've worked. Form 1099 are used to pay and report independent contractors. Now, who is an independent contractor? I'm not going to be able to tell you definitively because we don't know definitively, but I can tell you a couple things that are the key ingredients. One is, what element of control do you have over the individual? If you are, quote, the business owner and you've hired somebody, do you have an element of control? If yes, control as to where they work, how they work, when do they work, number of hours they work, that's probably an employee. And that's probably the key ingredient. How much control do you have? You could have some of those controls and yet still have an independent contractor, but the more you have, the more likely that the IRS and most tax lawyers would say that's an employee. You don't want to be playing the game of employee versus independent contractors to say that there's payroll taxes, because all it takes is an employee who gets a Form 1099 to go to their tax account and find out that they owe self-employment tax, both halves of the Social Security, where they would only have had to pay one half if they had been an employee. Once they find that out, and they didn't realize it when you set them up as an independent contractor, well, that could blow your cover in trying to save that extra 15%, or half of it. As an employee, you pay the 7.65, half the 15.1. So you would not win the game necessarily if they really don't belong as independent contractors. And one last thing on the subject, and then we move on. You can have a nice document that says independent contractor on it, have the employee sign it, and guess what? That means nothing. It's not worth the paper it's written on because it's based on the facts and circumstances. So be careful. Utility expenses are deductible. Business insurance is deductible. Education expenses can be deductible if they are helping you in your business. So to the extent that it helps you in your business, the education, it's giving you knowledge that you need to have, that you deem you need to have, then they are deductible. It would not work if it's for the minimum degree you need to practice a particular business. For most of us here, I don't think this is going to be an issue, but the classic example is somebody who's going to law school to be a lawyer, and they're working at a law firm at the same time. So if they try to deduct the law school, the IRS will say that doesn't work, because even though they're working at the law firm, they're not a lawyer at the law firm, and therefore the expenses of the law degree are to prepare them for something different than they're currently doing. But for most of us here in this audience, I think an educational seminars, webinars, coursework at the university probably is deductible. Now, you may say, well, you give me a lot of lists. I'd like to know what the whole, so this is Schedule C, just so you'll know. I'll just write this down and erase it. This is Schedule C from the Form 1040, an individual return from Form 1040. This is where a sole proprietor reports their income and expenses. I'm listing here the expenses so you can get an idea of what other things might be deductible. And you've got car and truck expenses, which we're going to talk about. You got advertising, you've got commissions and fees, looking all up here for now. There's your contract labor, which is your independent contractors, depreciation, employee benefit programs. That's another great tax deduction for yourself and your employees, insurance of all kinds, interest on loans, legal and professional, which is always good for people like me, because I can tell you when you complain about my bill, I can say, well, it's tax deductible. There you see. Office expenses, pension and profit plans. At the end, if we get there and have time, we'll talk a little bit about those. Rents on vehicles, rents on property, rents on machinery, rents on equipment, repairs and maintenance. So this gives you a bigger idea of what are things that are tax deductible. Travel, overnight travel for business purposes is deductible. Travel and meals are on here, but only to the extent of 50%. So when people say, oh, I'm taking you out to dinner and I'm going to charge it on the company credit card, they get to deduct 50% of it. Guess it's better than nothing, but it's not a home run. There's utilities, pay people you pay, and then other expenses. So let's spend just a little bit of time on this concept of other expenses to make you have the general principle of tax law when it comes to deductions for business purposes. And I think I can do that in maybe just about 60 seconds. Section 162 of the tax code basically says that a tax deduction for a business is anything that is ordinary and necessary for the business. And that leaves a lot of room for ambiguity, and it's exactly the point I wanted to bring home. Anything that you do that in your mind is helping the potential to earn income, and it's only if it would potentially help it. You don't have to actually be successful. Anything you do that has the potential to bring in income today, tomorrow, the next day, then that meets the definition of ordinary and necessary. In most cases, there are exceptions where the tax code specifically says, oh, that won't be deductible. I'll give you the classic example so you won't walk away wondering and scratching your head. But before we did that, just to reiterate, the concept is if you think it's required to help you earn income, then in most cases, as long as it's a legal expense, it's legal. It can't be doing something illegal, but you think it's good for your business to bring in income, like advertising or like flying to meet somebody and give them a lunch, then that will be an ordinary and necessary deduction. The tax court basically leaves it in the mind of the owner to determine what is ordinary and necessary. Again, that's a generalization, but it's basically the tax court principle. The one exception that exists in the code today, the big exception, is entertainment. Tax code right now until 2026 has sort of put the brakes on taking entertainment expenses as a business deduction. Yes, I know people take clients to ball games and they take them to other types of entertainment, and they do it because they feel they needed to please the client and woo clients to stay with them and come with them. That's right, but it's not tax deductible. All right, let's talk about some what we call new business tax breaks. And we're going to talk about qualifying startup expenses. which at first blush won't seem to be anything new from what I've said thus far. But the point is this, and here's another tax principle. All of the deductions we've talked about, all the other deductions we've talked about till now apply to when a business is operating, because then it's a business. These are all operating business expenses, and that's the concept of that section 162 that we looked at. The business is operating. What about if the business is still on the drawing board? You're making up a business plan, you're researching, you're beginning to test the waters. Those are what's known as startups, because they're not, the business hasn't started yet. They're pre-startup, you might say, but in the tax code, they just use the word startup expenses before opening. Since the tax code allows all those ordinary expenses when the business is operating, that's fine. But what about a startup? The tax code has a lot to say about that. Basically, it says that what you're going to have to do is you got to hold on before you can deduct those. You got to hold on to wait until you are a actually operating business. I'm overstating the details because there's a few nuances which I don't have time to go into, but the large concept is what's going to be generated here, and that is in most cases pre-operating expenses are going to be held until the business begins to operate, and then you get to take those deductions slowly over a 15-year period of time. 15-year period of time. But at least you don't lose the deduction. You do get to take them. And if your business closes before 15 years up, you take it all at that time. So the concept of pre-startup, startup expenses is one that you want to be conscious of. In a way, you might say to yourself, and it would be not a bad idea, and that is to get started as quickly as possible so that all your expenses come under the classification of operating expenses. And that's not a bad concept. So to minimize your startup expenses in order to get them into this category as an opening and operating expense, it's not a bad idea. What are some of the operating expenses that you could have? Well, creating the business, meaning market research, product analysis, all this usually happens before you have an ongoing business. Travel related to locations, selection, and things like that. Launching the business, cost of hiring, training. Think of a restaurant or a hotel. Before they actually become an operating entity, an operating hotel, operating restaurant, they go through a lot of buying the equipment, hiring people, training them, testing them out. They bring all their friends the night before they open, and they go through the motions of preparing meals and serving to see that everything's working smoothly. And then the next day they open. Everything up until that point is a startup pre-opening expense. We won't go into this in detail because this takes an hour or two probably to do justice to it, but I don't want you to go away without knowing that there is a particular tax credit. Remember the word credit being better than a deduction. This research and development tax credit for startups and ongoing businesses, but it's very valuable to startup companies because it might allow you to avoid a huge payroll cost if you have a lot of payroll. I'm going to give you the number in a minute, but if you have payroll in a big way, let's say in a environment where you're trying to create computer software, so you hire a lot of computer programmers and analysts to help develop the application, the R&D tax credit may be very valuable as you're doing that kind of business. It's up to $250,000 off your payroll expense for startup companies meeting certain definitions. So it's a huge type of credit, reducing dollar for dollar your payroll costs. Main thing to get out of this in a webinar as short as this is understand that research and development expenses can lead to a very valuable tax write-off, tax credit, tax advantage. Just to give you a flavor for what qualifies, you have 4 steps. You have to determine, do you have a permitted purpose to be doing research and development? And the answer is usually that's easy to answer. Yes. Number 2, is your project technological in nature? Oftentimes in the STEM science world, it's almost always the case. So number 1 and 2 are not too difficult, and 3 and 4 wouldn't be too difficult in a typical startup business under, let's say, research for pharmaceuticals, things like that nature. But what's interesting is the following, is that even if you're not in that classic sweet spot of a pharmaceutical company, but you're simply, I'll give you an example where we've used the research and development credit in our own client base. We have a furniture client. What do? They sell furniture. How do they get the research and development credit? Well, they're creating technology of computerization of their business affairs internally. And that creation has a technological uncertainty to it, whether it's going to work or not. And they have to test various ways to see if it's going to track the type of information they want, if it's going to make their computerization of the sales that they do faster. Maybe as long as there's this technological uncertainty in computerization of a business inside the business, we're not even going to sell it, just internally looking for the best way to do something where we have to have some degree of testing to see, is it A or is it B that works better? That will fall under the category of research and development. So my bottom line point is, don't think that if you don't fall into what sounds like a pharmaceutical company that you don't have research and development. That basically should ask a tax professional, where in your business plan and your business applications and processes might you actually have it?
Could I jump in with two questions?
Certainly.
And so this is actually one slide prior to the R&D. This is about, so the first question is, what is the definition of operating versus startup status?
Great question. Great question. And the definition is when you are open for business. So you want to be an operating company, you got to be open. You got to be ready to accept customers, do your service, sell your goods. You don't actually have to do it. You just have to be ready for it. So you can somewhat control your fate as to when you're going to be open by having the doors open, having the website be live and accepting inquiries and able to deliver any product that is being ordered at the time. So if you're not quote unquote open and you can't prove that you're open, ready to do business, then you won't be considered to be operating. Next question.
Great, thank you. The next one was kind of similar, but says it could take some time for a startup to be profitable. What does the IRS treat your LLC as during that period of time?
Okay, so if you are actually operating, but you're losing money because of the nature of your business plan, you're still operating, and the losses, as I insinuated, are technically deductible even on your individual return through the pass-through. There is a concept of hobby losses, but I'm not going to do that. The hobby losses say that if you have losses 3 out of 5 years historically, then maybe it's a hobby and not a real business. But that's rebuttable. The hobby loss rule is rebuttable. It's just a presumption. If you have losses 3 out of 5 years, then the IRS might say it's a hobby. You can't take the losses against other income, but it's rebuttable. And I've successfully rebutted many of those. So I don't want to go into that but that's basically answers that question.
Okay, thank you. And then the last one about R&D, and we might need a little clarification here, but it is, what about when you create a product and have to test material?
Absolutely. And that sounds like it's right up the alley. If you're testing something to see if it works and it may not, then and you have an element of risk. That's how I was in my simplification mind, my simple mind of how to look at an R&D credit is you've got a choice between A and B, and you got to test to see which one's going to work. So you have that A-B situation, and you must test to determine which way to go. Then you probably have something that falls under the research and development tax credit.
Okay, thank you.
Okay. Thank you. Here's a checklist for startups, which might be good just to post our slides on the website or attached to however you're doing these, Josh, but these is basically a checklist of things you're going to do to get your entity started. I don't think that's really the tax aspect, but I put it together here anyway. All right, trying to get through a few more slides related to taxes. There's energy efficiency credits, which apply not only to homeowners, but to businesses as well. Solar, geothermal, things of that nature. Don't, get your tax accountant to go through the checklist of what is out there. It changes from time to time. Congress plays with these credits. Again, there's that word credit. So these energy efficient credits can read taxes dollar per dollar, and they might be very, very valuable. Solar is a big one. Again, it's the details of which are beyond the scope of this general explanation, but I did want to mention that. If you're in business for yourself, whether you're an LLC or a S corporation or a C corporation, you're going to probably get to the point where you're going to pay your taxes not through the withholding that you do as a W-2, but you're going to maybe looking at paying taxes quarterly for your own individual taxes. That's a possibility. Just keep that in mind, that when you're your own employer, the name of the game of how you pay your taxes as you go changes. Concept is we have a pay as you go situation here in the United States, pay as you earn, pay as the profits are made. So that's why quarterly payments are being mentioned. All right, retirement plans, if you're your own owner, I know we all work for organizations that have retirement plans. They're great. If you're your own employer and your own owner and you have employees, even if you don't have employees, retirement plans should still be something you take a look at as your profits begin to roll in. There's a great way to get a tax deduction and to save for retirement. Solo 401ks for sole proprietorships, that's a really great deduction to have. SEP IRAs, I'm just giving you the names. You need, for these, by the way, you need a pension administrator to help walk you through it. They'll help plan and design what's best for you. Loan payments are not deductible. Let's just put that on the list. But the interest of the loan is not deductible, but the interest portion is. Car, yeah, you got a car. What you want to do is talk to a good tax accountant or read a little bit about it. Using your car for business can yield a nice tax deduction, and it could be a personal car. But if you're using the car for business, you want to keep a log of when you have those business miles. So you would want to understand what are business miles, what qualifies that. Generally speaking, it's as it sounds. You drove somewhere to meet a potential client. They didn't become a client. It's still a business use of your car. Keep the log. The tax regulations require a log. I know most people don't. So even a sample log for a couple months of the year will qualify under the regs. If anybody's doing computer programming out there, I want to talk to you about creating the best way to keep a log on someone's cell phone, because my clients don't keep it. All right, employee expenses very quickly here. What you want to do is don't pay advances of expenses that you might want your employees to have what's called an accountable plan. It basically means you reimburse. This, I haven't really done a good job of introducing this topic, but I wanted to fit it in somehow. If you have employees and you want to give them, maybe the better word to describe is you want to give them an allowance. Here's an allowance for your car. Don't do it that way. It's not tax advantage to your employees. They have to pay the tax on the allowance. Whereas if you just reimburse them for their car use or their meals for clients or their supplies, do it. It's called an accountable plan. That's the way to do it. Just put that in the back of your mind in case you're operating or when you're operating. And if you got employees, remember to ask the question if you don't remember the details here. Permits and license are deductible, and corporation fees are deductible. Logo design becomes deductible as part of those startup expenses that we described. These all become deductible once you're operating. So it's all a matter of timing. If you can avoid doing the logo until you're actually in operation, if you can avoid paying for this until you're actually in operation, then you avoid the startup rules where you have to smooth it out over time, which is known as amortization. So that's a timing issue. Down payment on rental property is not deductible, but the property itself, rental property. No, rental property, the down payment on it, which is, I guess the way to call that is the upfront security deposit. Let's call it that. That's not deductible. That becomes an asset. But the rent itself is. So that's no. But the rent, the actual rent is. And if you make a couple months a payment of rent, it's not deductible if you haven't started your business yet. So again, it falls into that category. Improvements, let's see, preparing the business to open, organizational costs. So that's the whole thing. Let's go back. Timing is everything, and here's some of the things to think. Improvements to the location. If you do improvements that will be, let's call it part of real estate, it's part of the building, that may yield a nice tax depreciation once you start. So that's not a big deal. But if you are just preparing the business to open, all the expenditures that are happening get into that category of startup, and they get frozen. We called it held over to when you start. Organizational costs, same thing. So timing is everything. All right. Once you're open and if you have employees, even yourself, even if you're the only employee, take a look at all the fringe benefits that are out there, because you're looking for tax-free fringe benefits where you can pay yourself, pay your employees, things that you do need to have, but they come under the category of tax-free to you, deductible to the business, but tax-free to the recipient. That's what it means, and that's the value of tax-free fringe benefit plans for employees. Probably, if you've ever been a full-time employee anywhere, you might recall making the trip to the HR department to find out all the plans that they have for employees. Why are they doing it? Again, many of those were tax-free to the employees, tax deductible to the business, so it helped create a better package for the employees to be compensated with. It helps attract employees. So optimize the retirement plan we spoke about, accountable plans we've already talked about, maximize the automobile deductions. Let's go back to this just for a second. I said you have to keep a log. That's true. There are two ways to actually take the automobile expense deduction. The one way is what's known as mileage. Just based on your miles, you multiply it times at a rate that the IRS publishes, and that's your tax deduction. Currently, the rate is a little over 60 cents or something per mile because of the gasoline and costs have gone up. The repairs and maintenance costs have gone up for a car. So it's like, I think it's over 60 cents per mile. And the result is if you keep a log of your business miles, that becomes your source of taking this deduction using the mileage. The second way of doing it is what's called the actual expenses of ownership of the automobile. If you've got a truck for the business, you're going to want to go to the actual. If you have a luxury car that's almost assuredly just for individual use, even though you're going to use it for the business, you probably, in my opinion, you want to really go the mileage rate, because taking the actual becomes subject to limitations in the tax law, and it becomes more subject to scrutiny by IRS on an audit. So I have found in practice, although the actual may yield a larger deduction, that's true. I have found in practice that it almost doesn't pay to go through the motions of what you need to do to get the actual expenses into your tax return versus the mileage, which is so much simpler. And the mileage, as I was saying, when on an audit with the IRS, goes a lot easier than trying to sustain the actual expenses of an automobile that is really more of a personal use automobile. If you have a truck, if you've got a van, if you have an SUV, and you really do have to take items in the SUV, so you need the space of an SUV, and you got a different story where maybe the actual expenses add up. There's one particular one that becomes desirable by a lot of clients who can sustain either the truck or particularly a large SUV. And that is that for SUVs that have a gross vehicular weight of 6,000 pounds, this is the fun part of taxation, by the way. If it's 6,000 pounds or more of gross vehicular weight, I guess GV, BMW. The dealers know who these are. They know which ones are. So if you go to a dealer and you say, is your SUV, is this one meet the 6,000 pound limit for the IRS? They'll know which ones it are. And those, if you can show 50% or greater than 50% business use, if you can sustain greater than 50% business use of that vehicle, where you're really using it because of what it can do for you, then you get to write off a huge deduction in the year you buy it. So I have a lot of clients who get interested in doing that towards the end of the year. They see they have a lot of income, they want a big deduction, and they want a new car. I think the BMW, one of the BMWs satisfies this. There's a bunch of them, not a lot of them, but they're out there. Certainly the Land Rover's got some that meet the requirement. All right, hire your family to work in your business. Yeah, not a bad idea, particularly if you're hiring not necessarily your spouse, because that's not going to necessarily save you much in taxes. So that wouldn't count. But if you have children under the age of 18, so if they're less than 18 and you hire them, there's no payroll tax. And you can't hire them for a lot of money. Don't get me wrong. You can't pay somebody 14 years old. And by the way, they need to be old enough under state law to actually work. If they're too young to actually be working, then that really won't fit the IRS criteria for paying them a salary. But if they're less than 18, let's say 16, and you hire them for the summer, there's no payroll tax. That saves you money there. It's a nice savings. And in addition to which, whatever you pay them, you can, what my clients do is they don't actually give the child the net payroll check. They take the net payroll check. So they take the net check and they simply put it into an IRA for the child's eventual retirement plans. It's a nice gimmick. It's not a big tax savings, but it's a nice benefit of having your own business, using family to work in and it often trains children to develop a sense of financial literacy, to understand that work yields this and why didn't they get their money? It went to an IRA and what's that all about? So it introduces kids to some interesting parts. We talked about the home office. I've left this for last. In 1 minute, I'll give you a quick overview of the home office deduction, and I'll take Q&A for about 5 or 10 minutes if we have it. The home office deduction applies to business owners who can meet the criteria. A whole litany of basic rules, and I'll just run through the general concept. First of all, you have to have a reason to have a deduction of a home office. So if you've got, like, take the furniture client who's got an office in the furniture store, he's got all his records there, and he takes it home at night to work on it, that's not a home office. So if you have an alternate place that you do your business in normally, home office cannot substitute as a deduction or add to a deduction, because you're just using it out of the convenience. But if you have a real reason to use your home, like, for example, you see clients there, potential or not, or even existing, you meet other business people there in your home on a regular basis, or if you have no other office whatsoever, then a home office is probably in your ballpark to take as a deduction. No other office available. And lastly, on the home office, what you want to do is, in order to sustain it, if you meet the criteria for it, you want to sustain the deduction, you want to be able to do the following. You want to be able to show that this particular space is dedicated for the home office. You really don't want to have it in an area which is clearly a playroom or a living room that is being used at other times during the day for personal use. So you want to be able to cordon off, so to speak, space that's dedicated for that purpose. Okay. Let me find my. All right. Are we still on here? Okie dokie. All right. Any questions? Anybody wants to do it as discussion, you can unmute your mic and I'll try to answer.
Yeah, I can, I've got a couple questions here in the chat, but if other folks have questions, I can allow folks to talk and ask those questions. We are at
Okay.
2, and so if people need to head out, you can do that. I'm going to end the recording right now though, but just appreciate everybody for attending. The first question, and then while you're answering this, Valentin, I'll have you come off mute. The first question was, can I loan to my own business, LLC or C Corp? Are there any tax benefits?
No real tax benefits, but you can loan to your own business, of course. There are some tax rules depending on how much you do loan. There's a question of whether it's a loan or really part of the equity. So that opens up a whole Pandora's box of issues, but certainly for you to invest in your own business, either by loan or putting in equity or putting in common stock, owning some of the common stock of a corporate entity is certainly fine.